Joining us now to discuss more is Tom Rogers, Engine Media Executive Chairman. He's also a former NBC Cable President and a CNBC contributor. Always a pleasure to see you, Tom.
Great to be here. Good morning, Melissa.
Do the most recent results, and specifically on Disney Plus and the streaming venture, does it prove out Disney's valuation?
Well, they certainly did well with the parks, and you'd expect them to do a lot better because the parks are open. I was very impressed, though, with the demand, particularly in the U.S., given that that's all off of domestic travel, no international travel yet. So that's a pretty strong showing. I got to say, when it comes to the streaming side of things, I'm a bit more skeptical. The headline number is a big one, 116, and obviously the market's rallying around that because the stock trades on that metric. But you got to dig into that a little bit. And it was admitted on the earnings call that the majority of those subs come from Hotstar India, which are really, really low revenue subs. I'd put them in a whole different bucket than the rest of the streaming world and what everybody else is really going for. And then you ask the question, so how did they do in the US? What were their numbers? And they really obfuscated on that. We never really got a new sub number in terms of incremental growth in the US. Now, they did say Hulu grew by about 1 million subs. That's a domestic only service. ESPN Plus grew by about 1 million subs, domestic only. We knew from HBO Max that they actually grew 2.8 million subs in the US. We know Netflix lost some subs in the US. But we came away after Disney threw all this high energy movie power, putting their foot on the gas, as Chapek said, and we really didn't find out what did that do in the domestic U.S. market in terms of their big story, Disney Plus. So I have to say I came away a bit more skeptical.
And Tom, you've raised the issue of the lower quality paid subscriber coming from the international market. In your estimation, what percentage of the total subscribers would that be? And are we really looking at a low quality paid sub growth component that is powering these numbers?
Well, they said about 40% of subs now come from Hotstar. And it was a big number in the quarter because the revenue per subscriber came way down. And that is a function of just how many Hotstar new subs there were in the quarter. There are other issues weighing on the profitability of their streaming business. In addition to Hotstar, Hulu Live, which is their bundle of channels they sell as a streaming cable operator, is also very low margin revenue. And ESPN Plus today, given the rights cost being absorbed there, is low margin revenue. So about 30% of their revenue is pretty low margin. And then you have this other issue, which Netflix really doesn't have, and that's the tax that they get applied to their revenue from Roku, from Apple, from the telcos who are partners in initiating subscribers for Disney Plus. And that's a 20 to 30% tax on revenues. So there are a lot of profitability issues when you look at their streaming revenue that I don't think the market is really focused on. They like that headline number.
Shepard Smith here. Thanks for watching CNBC on YouTube.